Hey everyone, a few days ago, there was yet another proposal to modify the Social Security rules. This particular rule would eliminate the taxation of Social Security benefits on a federal level. Now, this has hit the news, and a lot of people are really excited about this. So today, I want to get into this and talk about what this bill would give and what it would take. But before we dive in, if you haven't downloaded my Social Security cheat sheet yet, look for the link below. I cover the taxation of benefits and a lot more in this, and next month, we're going to be updating this with the new information for 2023. And if you download the current version and stay on my list, I'll automatically send you the new version as soon as it's updated. Again, there's a link down below where you can get your free copy. So this new legislation has been introduced by Representative Angie Craig out of Minnesota. She's titled this the You Earned It, You Keep It bill. The basic premise of this is that all Social Security benefits will no longer be subject to federal taxation, and the missed revenue that would normally come in from taxes would instead come in from increasing the maximum taxable wage base. Now, in the press release announcing this bill, Representative Craig said, "Social Security is a promise we have made to the American people. If you work hard and play by the rules, the dignity of a secure retirement will be within your reach. But taxing the very benefits American workers have earned after decades on the job diminishes our promise and threatens to undermine the financial security of retirees already struggling with rising prices. Eliminating this tax will help Social Security benefits go further and ensure that American retirees have all the resources they need after a lifetime of hard work." I agree 100%. I don't think Social Security benefits should be taxable. And they weren't taxable either, all the way from January of 1937, when the first Social Security benefit check was paid, all the way through the beginning of 1984. The original thinking was that since FICA taxes, which are the payroll taxes that fund the system, are paid with after-tax dollars, the benefit from them should be tax-free. And there were 3 separate Treasury rulings in the early days that explicitly excluded Social Security benefits as taxable income. 2 of these were issued in 1938 and 1 in 1941. And then all 3 of those rulings were reaffirmed in 1971. But this all changed as a result of the Greenspan Commission. President Reagan appointed this group in 1981 to figure out how to fix Social Security because, much like we hear about today, the trust fund was getting very close to running out of money in the early 80s. So they had to do something, and they had to do it fast. So the Greenspan Commission saw taxing Social Security benefits as the low-hanging fruit to solve the problem. And despite those earlier Treasury rulings, they knew that they could get this done by using the rationalization that taxing Social Security benefits was based on how the program was funded. Employees paid in half of the payroll tax from after-tax dollars, and employers paid in the other half, but then could deduct that as a business expense. That meant that only 50% of payroll taxes were already taxed. That's the employee portion. And thus up to 50% should be taxable after it was paid because Uncle Sam hadn't had their share of that yet. And so in late 1983, a law was passed which made up to 50% of an individual Social Security benefit count as taxable income. And once this tax was widely accepted, it didn't take long for the federal government to realize that they'd been missing billions of dollars in potential revenue. So the obvious next step was to increase these taxes again. And so in 1993, they did just that by adding a second level of taxation where up to 85% of a benefit could be taxable. But the rationalization they used to justify this was different than what the Greenspan Commission used just 10 years earlier. The members of the legislative committee that decided this said that if an average worker who lived to an average life expectancy would only pay in about 15% of their expected total lifetime benefit in their part of the payroll taxes, and therefore the other 85% must come from some other sources and therefore should be taxed. So that's how we got to where we are today, where benefits are taxable on a federal level, and now we have this proposal to eliminate those taxes. So what's the likelihood of this actually becoming law? Well, I don't think it's very likely for 2 reasons. First, the Social Security program relies on the revenue generated by these taxes to help pay benefits. In 2021, the taxes collected on benefits accounted for more than $30 billion in revenue. Representative Craig's plan is to offset this by increasing the taxes of workers with higher incomes, but with a looming shortfall facing the system in the next 10 years or so, I can't see legislators giving up any revenue. Second, the elimination of taxes would disproportionately benefit those with higher incomes. Because of how this tax is calculated, lower income people generally don't pay any taxes on their benefits. Typically, it's only those with other income sources like pensions and IRA distributions that are subject to taxes. The last number I saw was that only about 56% of benefit recipients actually pay taxes on those benefits. And so I can't foresee our current legislators passing a bill that would favor those with higher incomes. So I think this bill is going to die a quick death, and you probably need to continue planning your retirement as if you're going to owe taxes on your benefits. But this is an area where just a little energy spent in planning can have a big impact and save you thousands, because there are a few strategies that can reduce or completely eliminate these taxes. In a recent video, I cover these strategies individually, and then at the end, I get specific about who these strategies are most likely to benefit. So if you just look right here, you're going to see that video next, and I look forward to seeing you there.